Good evening, folks. Welcome to the Weekend Investing Daily Bite of 26th of March 2025. I'm Parikshit, filling in for Alok just for the day as he's away at some meeting. So the markets continued on their mode of consolidation. The last couple of days have been dull in the markets. If you see, the performance in March has been absolutely fantastic. The markets across the board have done really well, and a little bit of a pause after this kind of fantastic rally is absolutely par for the course and nothing to majorly worry about. So, US markets have basically been positive the last few sessions, good performance there. On the back of some hopes of lower tariffs, so we have the all important tariff announcements probably due next week. So all eyes will basically be on that. Maybe there is some jitters in the markets. That's why probably we are slightly consolidating. But if you see the inflows from FIs have turned positive after a very long period of time. The last 5 6 sessions have been extremely robust in terms of FIs putting in money into Indian markets. So that augurs really well, and there is also a very good chatter around the improving economic condition within the country. So there are good amount of cues. Let's see how March ends, how this financial year ends. Hopefully, the period going forward will be quite good for us. So the topic for today's discussion is you won't repeat this mistake after watching this video. So, what mistake are we talking about? How are people repeating this mistake time and again? And what is the statistic or data point we are going to give, which will help you make sure that you don't repeat this mistake? Please stay tuned to the second half of the video for this. Of course, disclaimer is extremely important. Please read this disclaimer. If you want to pause the video, please pause and read it. None of this is recommendatory in nature. All of this is just simply educational. Moving on, also subscribe to the channel. This is pure hard work that we are doing. So the only motivation is your subscription, your likes, and if you share the videos with everyone else, that's great as well for us. So where's the market headed? Nifty 50 minus 0.77% today. If you see, this trend line is something that we've been tracking, and after breaking away from this trend line, Nifty sort of is looking a bit sluggish. And the more important perspective here is that this resistance has not been broken. So there was a temporary moment yesterday, Tuesday session, where Nifty broke above this resistance, giving a lot of hope that probably we are going to continue going up. But each of these points are going to be very critical as we go forward. So there will be some selling that may be triggered every time the market tries to test either of these lower highs that have been created. So maybe Nifty is going to spend some more time consolidating before we have the tariff announcements, or maybe Nifty is going to fill this small gap that is there, or maybe come back and retest. Only time can answer. Nifty Junior down 0.39%. Of course, after this strong bearish engulfing that we saw yesterday, not a lot of people would have expected a different outcome today. Of course, markets, the segment was also weak. Mid caps down 0.63%, very similar to Nifty Junior as well. Probably may come back and retest this 40-day moving average. Small cap index is down 1.41%. This is the segment that took the maximum beating today, losing almost 1.5% to come back below 15,000 levels. There was a time when small caps broke above this level, but again we've come back to retest this 40-day moving average. Bank Nifty is also down 0.77%. So we probably were, I was probably hoping that Bank Nifty would come and retest this mark, but we have experienced some pressure from the sellers much before we trigger this zone of 53,000. So gold, in fact, while the markets are down, the gold has been very good, very positive last couple of days, good gains, reasonable uptick in the last couple of days rather. And if you see here, this was an important area of resistance that was created below 8,750, and after breaking out, we are seeing a retest of this level again. Market breadth advance decline. There were 112 advances today, and majorly declines. Of course, 388 declines. If you can very clearly observe how the trend has been going down in the last few sessions since the 18th of March. We've been consistently going down from 453 advances all the way till 112 advances. So the declines have been gradually increasing as well. So the maximum decline we saw was 478 on 11th of Feb. Whether we'll come very close to that or not, only time can answer. Today's heat map, of course, there is some mixed neutral pockets in today's heat map. The banking stocks have taken a bad beating. SBI, Bajaj Finance, Kotak Bank, all losing quite strongly. I think except for defense, I think not a lot of sectors were in the positive territory. I mean, in fact, majority of the sectors were in fact in the negative zone. We'll see that when we come to the sectoral analysis. Infosys also down. So IT stocks also predominantly down. NTPC losing about 3.3%, massive beating over there. So we are not able to. I mean, there's nothing good to share within this space. Within the Nifty Next 50 index, of course, HAL, Siemens, ABB, Bosch. These are the stocks that did really well. Varun Beverages, Ambuja Cements all did quite well, but there was a lot of weakness in this particular pocket. PFC, again, and some finance related stocks, REC, PNB, Union Bank, all losing quite a bit. Adani Group also losing quite a bit at 1.9, 1.2%. Adani and Sol also losing in line with ATGL. So moving to the sectoral trends, as we discussed, defense and MNCs were the only two sectors to return positive gains today. Apart from that, every other sector was completely beaten down. On a weekly basis, defense is again the topper. Monthly basis, also defense is the best performing index, and also from a yearly perspective, defense and capital markets have done really well. From a 1 week standpoint, of course, all the sectors are in green. I think except for metals and media, every other sector is in green, which is definitely good news. And the monthly performance also is quite good, right? Moving on, so this is the chart of defense sector, 0.53% after this breaking away from resistance, once again coming back to retest. Some of the best performance: Hindustan, Iran, Solar Industries, Mazagon, Dock, all doing quite well. So primarily driven by performance, some performance across a very few set of stocks. So coming to the discussion for today, you won't repeat this mistake after watching this. What is this mistake? So we recently came across a very interesting question on our Ask Weekend Investing episode. So this person asked, I keep falling into the same trap, chasing mid caps and small cap products during bull runs, only to realize that during a correction that my risk appetite cannot handle the heat. It is a cycle I repeat every market rally. How do I break free? Firstly, outstanding question. This prompted our team to go back into the drawing board and try and find out some data points that can make sure that people don't fall into this trap. In fact, we responded to this query stating that the first sign of success is recognition of the problem. So hats off to the user to recognizing that there is definitely a problem, and yes, this is in fact a very very big problem that surfaces across all kinds of investors, whether you are a new investor or a seasoned investor. Even people who have spent decades in the markets do continue to experience the same issue. What is this issue? uh, During bull markets, of course, we all know that small caps tend to take lead compared to mid caps and small caps. This is from COVID bottom to the recent correction top. Of course, there is a lot of chatter and FOMO that is created, especially at a time when small caps are breaking free from the large caps and the mid caps. People who are invested in large caps, slowly tend to succumb to FOMO and start thinking about moving their investments from large caps to small caps, or people start picking high risk products, high risk small cap segments, especially during market tops, right? And only to realize that this is not their cup of tea when the market starts to correct. So this problem has been evergreen. I mean, we get so many emails. I mean, across market cycles, we've been seeing multiple people respond to us, write to us stating that we are panicking about the situation. We don't know what to do with the small cap product. It is very volatile. Please move us into some large cap. Do this, do that. So a lot of confusion around this. And also during bear markets, people realize that of course small cap is not their cup of tea, and people also start to understand that large caps are less volatile compared to the lower market cap segment. So the question is it really worth trying to time your entry into various market cap segments based on what situation the market is currently in, right? What is the price you may have to pay for that? And all of this we'll try to check out in this video. So the study we are doing today is a simple SIP of 1,000 rupees in each of these categories. So large cap, we are taking CNX 100. Mid cap, we are taking mid cap 150 index. Small cap, we are taking small cap 100 index. Then we have gold as an additional show point, and two important portfolios. So a simple one third of your money invested in large, one third in mid, and one third in small, right? So out of SIP of 1,000 rupees, 333 into each of these segments. That is the combination one, and the combination two is 25% of your money goes into large, 25 into mid, 25% into small, and 25% into gold, just to see if it can give that bit of extra advantage to protect you during difficult times. So we're taking last 20 years of data, divided into four phases, starting from April 2005. Some may say that we are starting exactly at market peak, or the market bottom, so that one segment looks better than the other. No questions of any of these things. We are starting exactly in between of a cycle, and we are covering a cycle of 5 years, so that the data point is complete. So April 2005 to March 2010, 10 to 15, 15 to 20, and 20 to 25. Let's get into the data. Phase 1, April 2005 to March 2010. As you can very clearly see, the combination one is at 159% returns. This is a 100 index going from 259, from 100 to 259. So 159% gains, and the combination two at 154. So not so far away from large caps and gold. So gold, in fact, has been tremendous in this entire phase. As you can see, very smooth and stable throughout this phase, especially at a time when the markets were in crisis. So these two portfolios doing really well. Let's also check out the XIRR of these combinations. So large cap at 16.7, mid caps at about 16.9, small caps at 13.9, and gold at 20. Gold outperformed all the other indices, and the first combination is at 16.1% gains and 15.2. So just imagine, I mean, someone who is trying to make decisions out of FOMO to invest only in small caps, trying to constantly keep moving between large caps, mid caps, and small caps, depending on where the market is. Like, for example, going heavily into small caps around this period, and then trying to exit small caps and invest in gold, because you are seeing that gold is moving up at this point in time. So confused investor, or maybe someone who constantly keeps moving around, versus somebody who's taking a very simple approach of investing one third into each of these segments, or one fourth into each of these segments. So these two combinations proving to be extremely good, right? Almost on par with large caps, uh, you know sort of in between, large caps and gold. So mid caps did well, of course, during this period, XIRR of 16.9%. But these portfolios, a blind approach also would have been great. So adding a little bit of gold would have helped you to remain calm during the GFC crisis. Phase 2, we take again, the combination 1 is exactly at spot number 2, whereas the combination 2 is at spot number 3. Not bad, right? If you see, there are all the other segments are right over here. And let's quickly take a look at the XIRR. So this phase was not so good, of course, but if you see here, 2010 to 15, the combination one was at 18% XARR. Fantastic, fantastic gains yet again over here, almost beating other segments handsomely, slightly below the mid cap. Mid caps had a tremendous phase during this particular period. The combination two also did really, really well, adding some gold, despite gold not doing well. Adding gold, due to the uncorrelated nature of the asset class, also helped better the performance overall. So great gains, and simple, no nonsense approach would have helped you by a long way. Phase number 3, yet again, the combination one, also at about a loss, in fact. Combination 2 exactly not losing, not gaining anything. Let's see this phase over here. Gold again was the best performer in this particular phase, April 15 to March 2020, primarily because it coincided with the fall of markets during the COVID period. So end of March is what we were taking to calculate this. So that's why you're seeing this kind of a performance here. Yet again, adding some gold, minus 6.4%. So let's not dig much into this phase. Let's go to the final phase, April 2020 to March 2025. Here again, the combination one was really good at spot number 3. Combination 2 was also good at spot number 4, doing really well. Going to the XARR, 18.7% for combination 1, 18.4% compared to 13 2022. Of course, I mean, you did not make that extra 1, 2, 3% XARR. So that is absolutely fine, right? I mean, how many people are going to remain calm and remain sane, especially, let's say you're allocated to large caps predominantly. When the markets are going up, what is the guarantee that you will not be tempted to move to small caps? That problem always exists, right? So again, the full picture, if you see the entire phase of 20 years, 2005 April to March 2025, gold at 12.7%, large caps 11.8, small caps 11.8, and both these combinations have beaten large caps and small caps. That's the outcome that we wanted to convey in this video. Phenomenal outcome for a very, very simple, no nonsense, nothing to think through, no time to be given to even analyze what the markets are doing. Simply just split your money across segments and allocate them on a monthly basis without worrying about what's happening. Great outcome, phenomenal outcome. You probably would have ended up doing better than large caps and small caps. Mid caps, of course, had this very critical period when they did really well. So hence the inflated performance here. But going to the takeaways and the summary for today's discussion, large caps and small caps have the same exact XIRR, and gold has beaten both large caps and small caps during this period. This is an important statistic for people who keep complaining that gold does not give any returns, and all of that. We've done tons of videos uh, on the importance of gold. So first of all, gold is not to be treated as a return generating instrument. It is primarily for the hedge. We'll probably try to do one more video to showcase what happened to the overall volatility of these portfolios during all these segments. We'll cover it in a separate episode. But gold beating both large and small caps by a comfortable margin. And coming to the combinations here, so a simple one third allocation each to large cap, mid cap, and small cap. This combination has comfortably beaten both large caps and small caps. That's the important takeaway for this. That you did not worry about anything, yet you beat all the segments very handsomely, right? And then takeaway number four, adding gold has not impacted the overall performance negatively. So this is for people who think that if you have exposure to gold, then probably you are going to see some returns getting shaved from your overall performance. That is not happening here. Exactly the same performance, and in fact it would have contributed significantly towards keeping you sane when the market is insane. That is the beauty of having some exposure to gold that we wanted to showcase. Of course, don't waste your time. That is the takeaway for this particular episode. Don't waste your time in trying to time into the market cap segments. Asset allocation is absolutely critical to ensure a very smooth journey. Again, don't don't think that we are trying to advise you over here. This is not an advice at all. This is a very simple perspective based on data. That's it. These are data points to showcase that some of these false narratives can be beaten. Some of the FOMO that you probably have been experiencing can be taken out of the picture. This is just a data point for your educational purpose and also your understanding, so that you don't repeat the same mistakes. Now, over a period of time, a simple mixed allocation to all these segments has proven to be either on par or even better than individual segments. Don't worry about it. Of course, this has to be done keeping the risk orientation in mind as well. So you'll have to consult your advisor, financial advisor, to decide on what is a suitable segment for you. I'm not getting into that part at all. This is just a simple narrative to help you understand what happens if you just did a very simple combination. Adding gold, of course, can help a long way in bringing the overall volatility down and reducing the drawdowns. So, quote for today to conclude this is, putting all your money in one market cap segment is like loading all your toppings on one single slice of pizza out of the entire pizza. It can come across as a very bold move, but I'm not sure if it is going to be tasting well. Of course, adding some gold, your portfolio has good amount of seasoning and stability in the longer run. That's it for today's discussion. Let us know in the comments, what is your asset allocation model? Do you try to time your entry into segments, or do you maintain a very simple approach? We would love to see your comments. That your comment is what gives us a lot of motivation to further get more ideas and try and answer many more questions that you may have. So please do let us know in the comments. And thank you so much for joining in. Please do share these videos with people you know. And I will see you in the next video. Bye bye.